All right, so Chris writes in, not happy with the Schwab Intelligent Portfolios. He says, hey, I've been a fan of your YouTube channel. Since you've been an advocate of the Schwab Intelligent Portfolios, I want to send along some information that might have some good YouTube content. All right, so he moved all his money, his IRA, his wife's, and the Roth IRAs and their tax. So 5 accounts into Schwab Intelligent Portfolios. They're about 70-30 risk factor. He thinks it's the worst portfolio management decision he's ever made. He thinks is one of the reasons because they use fundamental funds that have higher than normal expense ratios, high cash allocations that make no sense. The portfolio performance has been abysmal since he started. And now he's formulating an exit strategy. He's going to look at Wealthfront. Okay. He's going to look at, he says, my KISS brain tells me the PhD eggheads at Schwab are totally overthinking things. He's going to look at T. Rowe Price. Okay. And then he gives me a chart that compares the year to date performance of Schwab into the aggregate index as a whole. This is why I got out of portfolio management, my friends. This stuff like this drives me crazy. I've dealt with this for so long. It just frankly bores me to death. It bores me to death. All right. Don't you don't have. I don't care. You don't have to buy the Schwab Intelligent Portfolios. I don't know how much more clear I could be that the cash. One of his arguments against they have cash, especially in IRAs. Cash is an asset. I don't understand why people just don't get it. That cash is an asset, be it in an IRA or not. Cash is a valuable asset. Now, if you don't want any cash, don't be in Schwab Intelligent Portfolio. I could not be any clearer when I recommend Schwab Intelligent Portfolio that keeps 7 to 10% cash. I got no qualm with that. So inherently on the upside, when they keep that much in cash, you're going to have less upside by a small fraction. If it doesn't beat the index, I don't care. Am I making close to index like performance with little fees? If the answer is yes, then be done with it, dude. Just be done. I don't understand just we spend so much time on portfolio analysis that it bores me because it's so minimal in the overall financial planning context about your portfolio versus this. But I hate to say it, dude, if you're comparing to 4 months time, you've been in there since November. He shows me a year to date thing. That's not even 4 months time. That's 3 months time based on the first quarter. Oh, Frank, it's just not worth your time. Um, then he argues about the fundamental funds that have higher than normal expense ratios. Dude, it's still Schwab. Again, I don't get paid anything from Schwab. I don't care. Go to Vanguard. I don't care. I literally don't care. I like the Schwab Intelligent Portfolios. I like the idea that for no fee at all, and the reason they're not paying a fee is because they keep some in money and cash, which they're loaning out, and they're getting net interest income on the 7 to 10% they keep in cash. I got no qualm with that. No one's hiding that from you. No one's hiding that from you at all. So I got no qualm with that in the least. But you will have some lag for sure because of the cash. Now the fundamental stuff, what the issue of the fundamental is they do two different portfolios. They're going to have a market cap S&P 500 index, and they're going to have a fundamental, which they use. I think they use sales growth or something like that. So they have some factors that I'm looking at, Pablo, in case you're wondering what I'm looking at, guys. They have some factors that they're looking at. Some of those factors might prove to be profitable. Some might not. I don't know. You don't know. Apparently over the last 3 months, they have not. I think they use sales growth. I'm not sure what else they use in fundamental factors. I just literally don't care because I say it's nice. It's a good portfolio. It's rebalanced. It's free, and you're going to keep some cash in there, and you're going to get close to market-like returns without a whole lot more risk. I'm very comfortable with that. I really am. I always caution. This is why I can't stand portfolio management because I always caution people. I'm not gonna. This is why I don't run money about looking at what has done well versus what has done poorly and jumping ship. And I just say use Bill Miller as a perfect example. Bill Miller ran the Legg Mason Value Trust. 15 straight years he beat the S&P 500. No one came close. 15 straight years. And he has a 5-star rating from Morningstar. It has 2005, 6 maybe it's 5. And I remember him saying, look, this can't keep up. It's just, he literally said, Bill Miller, this is luck. 5-star rating. Then he got swamped in the late the aughts, or I guess say 2008, 2007, 8, 9. He got swamped, and within 18 months' time, he went from 5-star Morningstar to 1-star because he was big in Countrywide, big in a couple other things I can't remember. And he got swamped, and all of a sudden, out of nowhere, freaking Bill Miller couldn't rub two nickels together. I mean, that's not true, but it's still, people didn't want to talk to him with a 10-foot pole, touch him with a 10-foot pole, because they thought he had lost his genius. And he always said, I don't have the genius. I just got lucky at the end. In fact, in 2005, I think, as the end of the year, he literally, I think it was the last day where a couple of things went for him that he beat the S&P 500. Anyway, he was the cat's meow for those 15 years. Well, but not for those 15 years, but for basically the last 3 or 4 when it got out that he was beating the S&P 500. Long story short, fast forward, Bill Miller still running money successfully. He had a couple down years. There's a guy named Chris Davis from the Davis New York Venture Fund. I'll never forget this guy. He says, look, if you're going to be a good manager, you're going to have years where you just look like an idiot. That's all there is to it. And then you're going to have years where you look like a genius. And neither are true. But if you are going to be a good manager in terms of outperformance, and again, why would you want to shoot for outperformance? I don't know. But people do, because outperformance is just outperforming the index, hopefully net of fees. It's not going to make you that much wealthier than just being in the index, but you be it as it may. But Chris Davis New York Venture Fund said explicitly, there are going to be many years where you look like a friggin' idiot. And there could be many years where you look like a genius. But anytime you're shooting for outperformance, you're going to have to take a risk. You're going to have to be a contrarian. So to beat the index, inherently, you have to be a contrarian. And Schwab is essentially saying, look, we don't know exactly which way the market is going to go. Will it be momentum or trend, for use that for an example? Will it be market cap? Will it be fundamental where it's just equal cap weighted? No one has any idea. So we're going to say we think our models would suggest that there's value here on our fundamental analysis in the long term to outperform a market cap. That's what they're saying. And they're saying, we don't know. We don't know. So we're going to keep a good position in market caps as well because we could be wrong. I like that. I like that they're literally acknowledging they have no idea. No one knows. Equal weight indexes over at Research Affiliates, they talked about many years about equal weight indexes as opposed to market cap indexes. And at the end of the around the 2008 crisis, the equal weight index looks like the way to go for sure. The last 10 years, it hasn't. That's just the whole thing about investing is just buy a freaking portfolio and sit with it. Be done. Stop. Now, if you want to go, and I'm not talking this guy specifically, I'm just saying for all you investors out there, if you want to match the index, you have to have index funds. That's it. And an index fund is simply matching the market cap weighted of the S&P 500. That means you have to have an S&P 500 index fund. It's literally that simple. I guarantee you, this is what I always say about indexers, though. I guarantee you, you will always underperform the index. Guaranteed. I can promise you that right now. Why? Because your index fund has fees. 10 basis points, 5 basis points, or it's going to have no fees and have a bunch of cash. I guarantee you, though, you will always underperform simply because the index has no fees in it. None whatsoever. It's a pure, it's clean, and is cost-free as a wind-driven snow. If you're going to buy an index fund from Vanguard or something like that, you are going to have a fee. Inherently, if you have a fee, you will always underperform. So when I hear people say, this fund is underperformed, that fund is underperformed, I say, well, what would you do instead? They say, I'll buy the S&P 500. I say, okay, so you're locking in underperformance. And then people start, oh, yeah, I guess I am. So is it that big of a deal? I mean, is it? No. I literally don't think it is. Look, the most liberating thing in the world, after finding Jesus, is to recognize it doesn't matter what you do. Just buy some stocks, some funds, I should say. Ideally, buy an index fund and just set it and don't even look back. Keep your fees low and be done with it. That's what you should do at all times. If you don't like the Schwab because it keeps cash, you should never got in there. I mean, it is explicit. It keeps cash. It could not be clearer. If you don't like the Vanguard fund, S&P 500, because it always underperforms the actual index, you should never have been there. But who cares? Just stop. Who cares? Invest, stay invested. Some years are going to be up, some years are going to be down. That's just the nature of the beast. Watch your fees, be diversified, and be done with it, and you'll be a happy investor. All right, we'll see you.